So welcome back traders, another exciting video. In this video I'll be sharing with you guys the tips on how to place your stop loss correctly and in the safest position possible. So but before we get into that, I'm going to be sharing with you guys 5 tips on why traders don't have stop loss on their trade. So let's get on with that first. So the first tip on why traders don't have stop loss on their trade is overconfidence in their analysis. Most traders are so arrogant and overconfident in their analysis. They think nothing can go wrong, so you just take the buy or sell and keep hoping and praying that price go in their direction. But that rarely happens. It gets stopped out. So overconfidence is one of the key reasons traders don't have stop loss on their trade. So the next tip is fear of being stopped out prematurely. Nobody wants to be stopped out of a trade. That's why most traders, when they are in a winning trade, they close it prematurely, but when they are in a losing trade, they hold it for much longer. Why is that? Have you ever asked yourself why is that? The whole trade that is in you are holding a losing trade much longer, hoping price will reverse at some point, and you end up blowing that account. Why? Maybe based on your analysis you were wrong, or the market is changing, because the market is dynamic. The market is not always moving in one phase. We have the push phase, we have the downtrend, and we have the uptrend. So maybe the phase in which the market is, the trend is changing, and you just keep on repeating the same thing, selling instead of buying. So that's another thing that will cost it, fear of being stopped out, and you keep on holding to losing trade. So the third, gambling mindset, the gambling mentality. Most traders have the gambling mindset. They take trading as gambling. They don't believe there is a science behind it. There are some patterns that repeat themselves daily. There are patterns which professional traders identify and make their analysis based on that. No analysis is 100%. Nobody can predict the market 100% of the time, but there are some things we call confluence, like evidence based on the time frame, strategy, patterns. These are the things that we use to identify where the market might go or what price might do next. So we are not predicting the market perfectly, but there are some things we put into place, some evidence which we use to identify what the market will do next. We anticipate the market move before the market does it. So that's what we use. So forex trading is not gambling. Don't use that mentality. You are not going to make it. So the fourth tip on why traders don't use stop loss is chasing losses or revenge trading. This is a very important tip, and I can truly say that all of us are guilty at some point. I personally have been guilty of that. After taking a loss, I increase my lot size and start trying to get back what I've lost, and it always ends up really badly. And when you start retrospecting and thinking about what you did, you identify it was an emotional decision and it was foolish, because after taking a loss I could have waited for a few minutes or close my chart and reflect on that trade, or distract myself. I was so overwhelmed and consumed by that loss which I've taken that moment, and I tried to make it back immediately and it didn't end up good. So it takes practice, but surely you get there. So revenge trading is one of the key reasons traders don't use stop loss. They just want to make back what they have lost fast, and that's a sure way to blow off your account. And the last tip on why traders don't use stop loss is lack of discipline. Most traders don't have that discipline. It takes time to develop discipline in forex trading, because the idea of trading without emotion is not real, as it was scientifically proved that we need emotion to make decision. So anyone that tells you you shouldn't have emotion in trading don't know what he's saying, because what the person should say is you should learn how to discipline your emotion. Know when your emotion take the best out of you, and once those emotions start coming up, you should study them, observe them, and still make a rational decision. That's what discipline is all about. Doing what you hate to do, but doing it like you love it, as Mike Tyson said. So it's not like you remove emotion totally from trading. We are all humans, we feel the same emotion. Nobody likes losing. We all lose, we all lost at some point, but we still try to keep a clear mind and make rational decision in the market. That's discipline. So that's the 5 tips on why traders don't use stop loss in their account. So let's get on to the few tips on how to place your stop loss correctly in the market. So we are currently on gold, and price is currently pulling back to a retest level in the market. The trend is down. Price is making lower low and lower highs, lower low and lower highs. So the trend is down. Price is currently pulling back to retest this level. Price is not really at the level yet, but we are not going to sell the market just yet. We still expect price push deep into the level, which is this level here, and this is the level where we'll be selling the market and placing our stop loss above the key level, because this is where your safest stop loss is going to be. If price broke above this key level, then the trend will no longer be down, which is sell. The trend will be bullish. So this is the level that keep holding that price. Once price break above the level, we will be looking for buys, and that's why our stop loss is above the key level, because the logic behind it is if price break above, then we are no longer in the sell bias market. So that's the idea behind the stop loss. Always place your stop loss above the key level. Take your trade at key level. What that does for you is it gives you a more smaller and safer stop loss, because if you take a sell here, your safest stop loss will still be above this key level. You can't place your stop loss here because price is still likely to pull back to this level. So if you sell here, your stop loss must be above the key level. So the logic is wait for price pull back to the level so that you have a more smaller and safer stop loss placement. So that's the logic behind it. So always take your trades and place your stop loss above the key level. So the second tip is, if you are going to take a trade and you feel that your stop loss is going to be too big, the logical thing you can do is, let's say if you are using the lot size 0.3, you can adjust your lot size to 0.2. If you are using 0.3 and you think your risk is too big for your stop loss, reduce your lot size to 0.2 and have a more bigger stop loss. It's better to sacrifice some of your rewards and your stop loss is in a safe position than to risk a lot and you have a more smaller stop loss, something like this. Let's say you have a very small stop loss, you risk very little and you have a bigger reward and price end up stopping you out. So it's better to adjust your lot size to 0.2 or 0.1 and have a more bigger stop loss and win the trade than to have a very tight stop loss. Don't try to cheat the market. Always try to have a good stop loss and you'll see consistency in your trade. So that's all for now. If you have any question, drop it in the comment section below and see you next time.